talked about this first slide, but our objective is to grow income and capital as a long-term independent board of directors, a very important feature of investment trusts, and we have an independent board under Laurie Magnus, who's a corporate financier and also acts as ethics advisor to Prime Minister Rishi Sunak. We have about 2 billion of net assets, just under 2 billion. We've been very popular in recent years issuing shares at a premium, but recently slipped to a small discount of about 2 to 3%, and we've been buying back shares and seen announcements, regular announcements to that effect. In terms of the management, I've managed a trust for an awful long time, since 1991. It's been a huge privilege, and I can't think of anything I'd rather have done. And David Smith I've worked with for over 10 years, and David was appointed deputy in 2021. We have a very low management fee, and the board have recently negotiated a reduction down to 0.3%. It was already low, but that's a function of the trust getting much bigger than it used to be. And the ongoing charge ratio is 0.37%, which is the lowest in our sector. That was last financial year. It will be lower this year with the new management fee. We've issued some very cheap long-term debt in recent years, taking advantage of the ultra-low interest rates. We've got a couple of private placement notes going out 25 years. You can see the coupons 2.67 and 2.94. So that can add a lot of value to shareholders over the next quarter of a century. I work at Janice Henderson in the Global Equity Income team. I'm actually the oldest member of the team. I'm 62, but James Henderson's only 10 days younger than me, so I'm in good company. But we've got a lot of colleagues who are mid-career and earlier part of their career, and it's a very cohesive team. We've all worked together a long time, but we also benefit from the resources of Janice Henderson, which was a merger between an American and British firm, and we've got analysts all over the globe, and that is very helpful. In terms of the investment style, it's sort of valuation driven. I mean, obviously the dividend we start with, but we want to be in the companies that can both grow their dividends and invest enough for the future, so I grow their profits. So we want to avoid the high yield value traps. And the other side of it is I'm quite a conservative character. So the companies we favour tend to be cash generative. They're the best able to pay their dividends and invest enough. And also I like strong balance sheets, particularly in cyclical industries. I'll give you more examples when I talk about the portfolio. So looking at performance, the chart there just shows you the performance since I became manager in 1991. You can see we're comfortably ahead of the FTSE All-Share, which is our benchmark and the main benchmark for the UK market. And if you look down at the table, we are actually ahead of the index over 1, 3, 5 and 10 years. Taking a look at more of the short-term performance over the 6 months to the end of December, I think it was a period where there was a feeling in markets that inflation was coming under control and interest rates had peaked. And cyclical sectors did a lot better than defensive sectors. So actually being underweight or underrepresented in pharmaceuticals, and although we got AstraZeneca, we're underweight there as well. That actually contributed to our relative performance. While some of our interest rate cyclical areas like real estate investment trusts and life insurance and house builders performed well during the period as people anticipated, interest rates beginning to fall in 2024. And notably, look at the big stock contributors recently. BAE Systems has been phenomenal. I mean, it's more than doubled since the start of the Ukraine war. And to be honest, sadly, I think the end of the post-Cold War peace dividend era has ended, and countries are rearming, and BAE, our main defence contractor, also the 5th biggest in the US, and interest in Europe and Asia Pacific and the Middle East and Australia. So it's a very strong company, lots of technology. 3i Group has is an investor in private companies. In particular, it's got an investment in Action, which is discount retail in Europe, and that's done very well. And we also bought Roundhill Music, which is a music royalties fund which got taken over. So they were the kind of real highlights. In terms of detracting sectors, you can see that food producers, which is pretty defensive, and Nestle in particular, which has been a good stock for us over the years, detracted. The biggest single detractor was St James's Place, which I misread, and we've reduced the holding. It's Britain's largest wealth manager, but obviously they've had to change their fee structure, and in addition, they're going to have to compensate clients who haven't had an annual review. So to move on to some of the activity over the last 6 months or so in the oil sector. I switched out of Woodside Energy, which is an Australian company focused on liquefied natural gas, into Eni, which is more of an oil play. I bought a holding in Burberry, small holding because there are headwinds in luxury, but this is Britain's leading luxury company, and its share price when I bought it was 40% off its high for the year. And then Hilton Foods is a meat packer and distributor. It started with a contract with Tesco's in this country and has expanded across Europe and into Australasia, and just won a contract from Walmart of Canada, which will open a new territory. So it's a good example of British company doing very well. And then in terms of other sales in the US market, I sold Cisco on a good profit, and also Ferguson, which was originally listed in the UK, but the building materials distributor, and has done very well. And Sanofi, the French pharmaceutical stock, which I switched into GSK mainly, or what used to be called Glaxo. In terms of the dividend, we are immensely proud of having the longest record of consecutive dividend increases for any investment trust, but I don't know of a UK quoted company with a longer record. But although it's been achieved by having a core of consistent companies, it's undoubtedly investment trust structure that has helped us do it. And the table illustrates the point. We've got a 30th of June year end. If you go to the year 30th of June 2020, you can see a massive drop in our earnings per share. So that they dropped from 19.76 to 15.73, and that was when you had all those dividend cuts at the beginning of the pandemic. Since then, the earnings have recovered quite dramatically over the next 2 years. So we dug into our revenue reserves in that year, 30th of June 2020. 21% dividend was paid out of reserves, whilst the last 2 years we have covered our dividends. So, without had that ability to use revenue reserves in difficult years, then we wouldn't have achieved the record. And in the good years for dividends, such as in the year 30th of June 22, we paid out 94.6%. We put the other 5.4% back into the revenue reserve. So this just gives you a chart of the dividend right going back to 1966, and then this splits up where our income comes through from each industry, and you can see it's a pretty broad split. So it's really, we don't have our eggs in one basket. We've got a broad spread. We're not going to be hit by any one sector. So talk a bit about the portfolio. So this first, the market outlook, this first chart just shows you how the UK market's done, and the top line shows you the world index, excluding the UK, and the bottom line is the UK market. You can see quite a notable underperformance. I mean, the main reason is the world index is dominated by the big US mega cap tech stocks, companies like Microsoft, Apple, which have been phenomenally successful. We don't really have the equivalent in the UK market, but even if you look at the UK market and compare similar stocks, it's still cheap compared to particularly the US market, but other overseas markets. And I think why you've seen a lot of takeover activity, and I think this kind of validates the point. I mean, even from our own portfolio, we've had Morrison was taken over, and Brewin Dolphin, and more recently there's been a bit of approach with Direct Line, which has been rebuffed. But we've also had Wincanton, which was taken over, and DS Smith is also involved in merger activity. And I think that's just from our portfolio. There's many other takeovers, and I think with the UK system of open corporate control, it shows that there is tremendous value in our market, and investors are being paid to hold on. In terms of market valuation, I've got two charts here. The one on the left measures the price-earnings ratio of the market, which is really relates share price to profits or earnings per share. And this is looking pretty interesting buying territories, kind of near the lows, i.e. very cheap on a very long-term basis, going back over 20 years. The second chart shows you yields, and it shows you with the FTSE Auto yield is now similar to what you get in fixed interest. The other lines are UK base rate, 10-year and 30-year gilts. But I don't find anything abnormal about this. Most of my career, equities actually yielded less than fixed interest for the very good reason that equities do grow their dividends over time. So overall, I'm pretty comfortable by the valuation on the market. Inflation, has peaked. It may prove sticky in parts, particularly with, wages. I mean, the minimum wage has gone up 10%, and Labour have said they'll put it up another 10%. So that ricochets through the whole differentials of wage structure. So I think the inflation is in a better place than it was, but I don't know about completely run, and some of the hopes and interest rate cuts may be a bit overblown in the market, in my opinion. So talk a bit about the portfolio. So we are predominantly in FTSE 100 stocks, as you can see, with a small amount in the rest of the UK market, and then also some overseas listed companies. We're never going to go more than 20% overseas listed, but in some sectors it provides some useful extra diversification. For example, in the oil sector, where we own ENI, and also Total Energies, which didn't cut its dividend in 2020, unlike Shell and BP. In terms of industry groups, financials is the biggest single group, and we are very positive on UK financials at the moment. In fact, I had the first speaker talk about being positive about the banks in Europe, and we think the UK banks look very attractive. For the first time for a very long time, the fund is actually slightly overweight banks, and they are producing very good dividend growth. They're producing good returns, and the current interest rate structure we got is much more favourable for banks when you have almost zero interest rates, and it's much easier for them to make the differential between what they pay depositors and what they're lending when interest rates are around these levels. So they had good results season, and we like the banks. We also quite like insurance. We've got big holdings in life insurance. Stocks like M&G and Phoenix have had good results, and also we had M&G, which has done well. And in non-life, we've had very good results from our Lloyd's insurers, Beazley and Hiscox in that area, and Sabre, smaller one, motor insurer. Consumer staples is a good anchor to an income portfolio. These are global companies, make everyday products. Unilever is our biggest holding. We do own BA Tobacco and Imperial Brands in this area, and they do provide very good yields and very good cash flow. Industrials, our next biggest sector, with BA Systems, which I've already talked about. Energy, we're slightly underweight, but we do have Shell and BP and Total and ENI, just under 9% in energy, and then about 8% in healthcare. So those five kind of industry groups make up about 3/4 of the portfolio. There's a lot bubbling underneath as well. Stocks like the Wincanton Logistics Company, which has been bid for by taken over by an American company, having originally been bid by a French company. But those five industry groups you can see on the slide are the main building blocks of the portfolio, and they're a fairly diverse set of industries. This just shows you, if you drill down our portfolio, where the underlying sales come from, and you can see that 2/3 of our sales come from outside the UK. So we would argue you're getting global exposure with City of London, but with a discounted UK stock market rating. And just looking at the top 10 stocks, I think I'd just like to point out that there are some low yielders here. BAE's now got quite a low yield, under 3%, and Relic, which is our second biggest holding, yields around 2.5%. And this is a business information provider and probably one of the best beneficiaries of artificial intelligence in the UK stock market. And it's been a very successful stock as a business. It's now 90% digital. You can see we've got also 3i groups are fairly low yielder as well. We can see we've got 2 oil stocks in the top 10, Shell and BP, 1 bank, HSBC, and then AstraZeneca is our biggest pharmaceutical, and you've got Unilever, the British American Tobacco, and Diageo from the consumer staples group. So the top 10 make up about 1/3 of the portfolio. And then looking at the next 10 down, Tesco's I count as consumer staples, our leading food retailer. Rio's is our biggest mining stock, and then we've got National Grid as our biggest utility. And some of those financials I've been talking about, Lloyd's and NatWest, are now back in the top 20, and Phoenix and Legal & General and M&G are all in the kind of life assurance fund management space. So the next 10 down make up 22% of the portfolio, so it's slightly over, it's around 55% made up of the top 20. So I'm just going to finish on 3 main points. We have 57 years of dividend growth, which is the longest record of any investment trust, achieved through having consistent companies at the core of the portfolio, but also undoubtedly with the investment trust structure. We have a very low ongoing charge, the lowest of in our sector, and very low for an actively managed fund, and it's set to go even lower the current financial year with the recent cut in the management fee. And we've delivered long-term outperformance of the index through a conservative investment style. So I'm going to pause here and be very happy to take any questions.
Joe, lovely. Thank you very much indeed. Thank you for the presentation. First question I've had has been around M&A activity. You mentioned a few examples. Is this overall a threat and opportunity to the portfolio?
Well, it's basically an opportunity, because usually takeovers, you get a much better price for it than the previously prevailing price. It wouldn't get taken over otherwise. But I think that it is also a threat in a way, and I think it's a good question, because we do lose some very good companies out of the UK market, which are very annoying to kind of lose in the long term. I remember we had Cadbury's in our portfolio, and I was very sad when that got taken over. We also had Boots, and the time I felt a bit sad. The benefit of hindsight, that was a very good deal for investors. But I think in the case of Wincanton, when the first bid came in from a French private company, I didn't think it was a particularly attractive level. It was, but subsequently, there were further bids, and the American company came up with a decent bid at the end, and I think we got a fair value. But I think it's, you're right in a way. You don't. I mean, Arm, which we didn't hold, but of course that at the time it seemed like a good price, but actually it's kind of been relisted in New York at a big profit for the people who bought it. So I think there is an aspect of it being a threat as well.
How vocal can you be if you think a company's being undervalued in that sort of discussion?
How vocal can I be? Well, you can just basically hold on, not or buy more. It's kind of what you can do. I try not to get too much sounding off in the press about if you start sort of raising your parapet, raising your sort of head above. You kind of. I'm not sure it's really for fund managers to do that, but it's but I think really you have to either buy more shares or kind of hold on to your shares. That's one thing you can do for sure, and you can make representations to the company and to their brokers, I suppose, as well.
Next question had is about the overseas holdings, and they're saying it looks like it's been declining over the last 3 years, the percentage held in overseas companies. What's the reason for that, please?
Yes, well, I think just the UK's just got so cheap that in certain sectors, like Sanofi had a profit warning, and French pharmaceutical company, and actually I looked at Glaxo and it was cheaper, and I think Glaxo, or GSK it's called now, is turning the corner and got some new drugs doing really well, new vaccine in particular. So it just makes you think that just recycle the money into companies which look undervalued and got better dividend prospects.
The next question says, we haven't seen people talking about UK financials much for quite a long time, so it's interesting to see the holdings there. And the question is asked, have you looked at Irish banks? Do you have any thoughts on Irish banks?
I haven't, to be honest. I mean, I think financials are quite complicated, and I prefer to stick to the UK financials. I think they're kind of enough to keep your head around. We have got Munich Re in which is a big German reinsurer, which I think the previous presentation had, and that's been a good stock for us actually. But that's our only overseas financial at the moment, I think, for financials. But I think financials is something we do quite well in the UK, and of course some of our UK financials are very global. I mean, HSBC in particular, most of its business is out in Asia Pacific, so it's not like you're kind of overly focused. I mean, something like Lloyd's is very focused on the UK, but you get plenty of overseas exposure as well for some of our financials.
And next question is asking about the source of the dividend, and the question is saying the largest companies in the portfolio, their yields are less than 5%, but your overall yield is around 5%. How do you make up that shortfall?
Yeah, I mean, that's the artificial skill of it. You've got to have a kind of balance. You need some low yielders like Relics, which is kind of going to give you the capital, give you terrific capital performance. But there are other stocks where you're going to get more of a return from the dividend. And BA Tobacco, for example, is yielding almost 9%, and the dividend is covered very comfortably by free cash flow. And so you need to hold that type of stock in order to sort of also own the lower yielding ones. I tend not to have zero yielding shares. Occasionally, if the company runs into trouble, it would be a mistake to sell it if it's not paying a dividend for a period. But I wouldn't. I wouldn't go out and buy a stock yielding less than 2, you know, but I think it's good. I think for me it works having some 2 to 3% yielders in the portfolio, which is going to give you that extra bit of capital growth to, you know, beat the index in terms of total return.
Okay, thank you. I think we're going to be out of time there now. So thank you very much indeed for joining us. And again, you know, apologies on the connections. And thank you very much. Really great to have an update.
Apologies. Good to talk to you. Thank you.